We're in the midst of a big sell-off today as September begins. NASDAQ heading for its worst day since the global market rout on August 5th. My next guest says markets will likely stay on edge heading into year-end. Let's bring in Chris Hyzy of Merrill and Bank of America Private Bank. It's good to see you.
You too, Scott.
What do you make of just how this September has started with today?
I guess it's like, things that we've seen, the replay over the last few months. Things happen so quickly. Things are fine, and then all of a sudden something happens.
Are they still fine?
Oh, they're still fine. Yeah, I mean, if you take a look at the high yield index, the investment grade index, they hit new highs in August. You're seeing participation broaden out. Earnings are going back up, and financial conditions are easy. It's not that simple, but I think people push that off to the side when you get days like this.
Well, I mean, Adam Parker just sitting in the seat that you're occupying right now and suggests that earnings may be going up, and estimates are not realistic, and they're going to start coming down. What do you think?
Maybe for some of the ones that carried the market before, but the other so-called 493 or so, we're starting to see something different. We're starting to see earnings actually go back up again and broaden out. It first was with the relative movement. Now you're starting to see it in an absolute manner. Next year, Adam could be right, where you see a slowdown in level of growth, but the participation's growing.
But isn't that a problem, though, if you agree that earnings are going to likely come down for the largest part of the market? Well, at the same time, you're suggesting that all these other areas are going to continue to go up at the same time that the economy is decelerating.
Yeah.
How does that make sense?
The economy is decelerating, but I would put it more or less and say it's normalizing. It's marching towards normal.
It's still slowing.
Still slowing, and that's actually a pretty good thing overall when you think about where we were in overall real and nominal GDP. So coming down, broadening out, and I would say it's healthy. And why is it healthy? Because you don't want a corner of the market driving everything all the time. That basically means that you're going to see elevated premiums and multiples. And I would argue, overall, heading into next year, if you get more participation, which we expect, returns might be lower on an annual basis, but deeper.
Do you think it's healthy, that your word, that things like staples and utilities and healthcare are, if not leading, doing quite well? That's not typically the makeup of what we would sit here and discuss being a healthy market. If you're bullish.
You're right. I would say that is a short-term move to so-called hedge some of your excessive beta, perhaps, for some of the short term. Longer-term investors might want that little extra yield in those areas as yields in fixed income are coming down. But actually, the next 8 weeks should be a very prime opportunity to rebalance your portfolio, get more diversified, and actually let the market activity go in your favor.
But I mean, if we're going to, the next 8 weeks, let's just take that time period. We're going to be whipsawed by economic data.
Right.
We're going to have Fed meetings, 8 weeks, we're going to have Fed meetings.
Right.
These other areas of the market you can rely on these other areas of the market. At the same time, we have all of that, and we're worried about the slowdown and an election at the end of these 8 weeks.
It depends on whether or not you're looking at just the next 8 weeks and you're going to stop, or if you're going to position those next 8 weeks, which we think, in our opinion, technicals could tell you another 5% to the downside.
So you'd rather be early. You're willing to be early.
Willing to be early.
Admittedly so.
And prescriptively. So you want to use your discipline, take emotion out, as long as the fundamentals march towards what we think is a more dehumidifying type of atmosphere, which is you take the moisture out of the market, sure, but you don't create enough dryness where you see cracks.
You say the consumer's stable. Does that mean that you want to be like discretionary as a sector?
Yeah, we still do. The consumer's stable. We don't see signs of a slowdown overall in services. We're seeing selectivity in the consumer for sure, but not a pullback. The area that's most interesting to us is actually financials. And when you think about adjustment rates lower, the market's already doing that for us. The Fed is just going to play catch up now. And that should help underpin a tailwind to the financials.
I'm getting you and Adam Parker together because I feel like you guys disagree on every viewpoint.
Okay.
He doesn't like the financials. I said, well, what happens in a normal environment for financials? He's like, they don't do well. They're terrible. I know they're doing fine now because they've been leading the market since the August 5th low, but rates are coming down, the economy is going to be a little slower. Why is that good for how banks make money?
Well, because the way that the traditional financials made money yesteryear, it's not the same as they make it today. There's a very different movement going on right now, much more diversified, better capital levels, actually be able to take advantage of an M&A cycle a little bit more efficiently than they did in the past. We can't just look at the past from a yield curve perspective and say that's going to happen in the future. It clearly didn't work for the economy as it relates to what happened with the inversion of the yield curve. There's a lot of different makeups going on right now, Scott, that many people haven't seen before. But one thing hasn't changed. When you get easy financial conditions and earnings are stable, that's a good market.
So don't fight the Fed.
Don't fight the Fed.
I have some people suggesting sell the first rate cut. I mean,
that's okay. That's okay. But then what are you going to do when the rally hits again heading into next year? Are you going to buy it back again? Too hard a time to market.